Okay, guys, today we will continue our bond chapters, right? So this is the second part. In the first part, I summarize the three rules, right, based on the comparison of a yield to maturity with the coupon rate, right, with the coupon rate, right? So now we will, based on these three rules, right, to do more analysis, right, of the bond price on different time, right, different time. So the first case is yield to maturity, right, equal to what? Equal to the coupon rate, right, equal to the coupon rate, right? In such case, what happened? Right, what happened? Right, if these two are equal, right, what happened to the bond price? According to our rules, right, if your cost equal to what you receive or what's your benefit equal to a cost, right, the bond should trading with what? With the face value, right? So bond price should be what? $1,000, right? We can double check this one, use our PV calculations, right? PV functions. PV, right? First one will be the rate, discount rate, right? Number of the period will be 10, right? What's the payment? Payment is the face value, right? Times what? Coupon rate, right? The future value is always what? $1,000, right? The tap will be 0. You got interest payment for the bond, right? At the end of each year, right? So we choose a 0 as the type of annuity, right? So you see the price will equal to what? Face value. That's for the first scenarios, right? When the yield to maturity equal to the coupon rate. Now let's go to the second scenarios, right? With yield to maturity more than the coupon rate, right? More than the coupon rate, right? So yield to maturity more than coupon rate, what happened, right? So your cost more than what you receive, right? Of course, you will not be happy, right? So bond for trading with what? With a discount, right? With a discount, right? So let's solve this one again, right? PV, right? Price and values, right? The price and the values functions solve the price and the value of the future cash flows, right? For a bond, we receive what? Coupon and what? Face value in the future, right? The rate will be 10%, right? Discount rate. Number of the period, 10, right? Coupon payment, face value times what? Times the coupon rate, right? Future values, 1,000, the tap will be 0, right? So you can see the price we're trading with our what? Discount, right? It's less than what? $1,000. Last one, right? You can say now the coupon rate more than yield to maturity, right? What you receive is more than what you cost. The bond trading with what? With a premium, right? So let's double check this one. Present value rate is yield to maturity, right? Number of the period 10. What's the payment? Face value, right? Times what? Times the coupon rate, right? Which values? 1,000, right? The type 0, right? So you can see the price of bond is more than face value. So the bond trading with our what? Premium, right? So this case is applied for what? Coupon rate, right? More than what? More than yield to maturities, right? So you can see the price can trading with a par, right? If the coupon rate equal to yield to maturity, or trading with a discount, right? If the coupon rate less than yield to maturity, or can be trading with our premium, right? If the bond coupon rate more than yield to maturity, right? So this price we just solved. Double check our three rules, right, in the first part of today's lectures, right? Let's move on to see the price for different time of the bond, right? I mean, all this bond we solved, the price is on what? On time 0. That means you just purchased the bond, right? You have all the coupon not paid yet, right? So the price will be like these numbers, right? Like these numbers, right? So PV rate will be yield to maturity, right? We will put dollar sign because we want to solve the price of the bond on different time. For this whole column, we're going to anchor the same interest discount rate, right? For the whole columns, right? Number of the period will be 10 minus, be careful, this will be different from previous calculations, will be the number of the period minus the t, right? So now it's time 0, right? You have the total what? 10 minus 0. So you have 10, period left for this contract, right? The payment is what? Payment is the face values, right? The face value, right? The face value times what? Times the coupon rate, right? Coupon rate. The future values, right, is the face value, right, is always equal to $1,000, right, times 0, times 0, right, ordinary annuity, right, and we can solve the price for the bond for all what, for all the 10 years. Okay, let's see what happened here. Okay, B2 is fine, right, with our discount rate, right. B6, okay, I see what happened, right? Be careful, right? For all these columns, right, we have the total number of years should be the same, should be always what? 10 years, right? So we need to anchor this one, right, for the whole columns, okay? So now we can, drag this one down, right? Okay, so you can see the price of the bond will stay the same and $1,000, right, from 0 to 10, right, if the coupon rate equal to yield to maturities, right. Next one, yield to maturity will be more than coupon rate. Let's see what happened to the price, right. We still solve the price and the time 0 rate, right, 10%. Number of the period, right, will be 10 minus t, right. Payment, face value, right, times what? Times the coupon rate. Future values, right, is always what? $1,000, right? The type will be 0, right? So that's the price on time 0, right? We can continue to track the price on the other period, right? You see, on time 1, right? How many periods left? Will be 10 minus 1. Only 9 periods left, right? So all the other inputs are still the same, but for the how many periods left will be different across different time. Right? You can see the price first trading with a discount, but when the time passed, right, the price of bond was going up until, right, the face value at maturity. Now let's solve the bond price. If the coupon more than yield to maturity, a rate, right? Number of a period will be still the time minus what? T, right? The payment will be 1,000, right? Times what? Coupon rate. Face value is 1,000, right? The type will be 0. Right? You can see the bond trading with premium and beginnings, right? Let's drag this formula down, right? You can see the price of the bond, right, will continue decreasing until the face value at maturities, right? So you can see the price movement, right, for these 3 different cases, right? If the yield to maturity equal to the coupon rate, right, the price will always stay the same with what? With $1,000, right? If the yield to maturity more than the coupon rate, right, the price will continue moving up, right? Until what? Until the price of what? Face value at maturity. Last one, right? If the yield to maturity less than the coupon rate, the bond will first trading with what? Premium, right? And the price will continue decreasing until the $1,000 and maturities, right? So that's the three, price movement of the bond, right? For different situations, right? So let's summarize these three price movement, right? Use the graph below, right? Use the graph below. The first one, right, is the yield to maturity, right? Less than the coupon rate, right? So on time zero, right? So this is time zero, right? Right? And this is time on what? On maturity, right? Maturity, right? Maturity, right? Maturity. Right? So if the yield to maturity less than coupon rate, the bond will trading with what? With premium and beginning, right? And the price will continue going down, right? Until what? Until maturity, the price will equal to what? Equal to the 1,000, right? $1,000, right? $1,000. That's for the yield to maturity less than coupon rate, right? If the yield to maturity, right, equal to the coupon rate, right, what happened, right? Then our bond price is always, trading with what? $1,000, right? So it's always equal to $1,000, right? From time zero to what? To maturity, right? To maturities, right? To maturity, right? To maturity. Last one, right? Last one, right? Is the yield to maturity, less than, more than the coupon rate, right? More than the coupon rate, right? In such case, right, our bond first will trading with what? With a discount, right? The cost is more than what? More than what you receive, right? So bond will first trading with a discount, but price will continue moving up, right? Until what? Until the face value and what? And maturity, right? And maturity, right? That's a three price movement of a bond price based on the what? Based on the different, yield to maturity and coupon rate, right? So that's the graph. I hope you can take the notes, right, for this graph. So next time, if you want to determine the price trend of the bond, you can compare what? Yield to maturity to the coupon rate, right? If you saw the yield to maturity more than the coupon rate, right? So in the future, the bond price will moving up, right? But if you see the yield to maturity just happen to equal to a coupon rate, the price of bond will always stay what? Stay the same, right? So you can base on the comparison of yield to maturity and coupon rate to determine what? Determine the bond price for different time, right? From the time zero to what? To maturity, right? But on maturity, all the three paths will merge, right? Will merge and what? Will merge, will converge, right? Will converge to the $1,000, right? That's the face value on what? On maturities, right? On maturities. So that's the price movement of the bond, right? Based on the first three rules we mentioned in the last part, right? Now we have something studied with our further steps, right? So let me know if you have any questions about this graph.